सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
The RBI Monetary Policy Committee has come out with its recommendations and, well, its policy decision once again. And you might be thinking, oh God, they come out with this quite regularly, so why are we talking about it once again? But the thing is that this regularity is what makes it absolutely very useful, because it gives us an insight into the way policymakers are thinking about a very evolving situation. Things like oil prices, global inflation, inflation in India change right now on a monthly basis. So what was the case just even a few months ago might be very different now. So to see what the policymakers are thinking, we need to analyze what they have said and what they've decided. And so that's why once again in this episode of Macrosutra, we're going to be looking at what the RBI's Monetary Policy Committee has said about growth, inflation and liquidity. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and we have with us, like always, Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us. So now, Radhika, let's go first to the absolute basics, which is what has the RBI decided on interest rates and what has their stance been? Has there been any change?
No, there hasn't been any change, and that was on expected lines, that RBI would not make any change in its policy rate and its stance. So if we just look back a little, since May 2022, the RBI has been tightening its policy rate, and from May 2022 to February 23, the RBI has tightened the policy rate by 250 basis points.
Right.
And since then, we have this policy meeting once every 2 months. So then we had in April, June and August. So for the last 3 meetings, the RBI has kept the policy interest rate, that is the repo rate, unchanged, as well as the stance. So the stance is that withdrawal of accommodation, such that inflation gets aligned with the 4% target while keeping the growth objective in mind. So that was on expected lines, though we can talk in detail about the fresh sources of inflation that have risen.
Right.
But in terms of decision, this is the third consecutive meeting where they have retained the policy rate, where they have kept it status quo, both the policy rate as well as the stance.
Right. And during the RBI governor's speech, he at least twice and maybe even thrice, he reiterated that 4% inflation was the target, and just because it's below 6% doesn't mean that we can go easy on inflation anymore. The target is 4% and that's what they're going for.
Yes.
But they seem to have also raised their outlook on inflation. Could you tell us a little more about that?
Yeah, so they have revised the inflation projection for the current financial year by 30 basis points. So in the June meeting, the inflation projection was kept at 5.1% for the current financial year. Now it's revised upwards to 5.4%. And the major increase has happened in this current quarter, that is July-September. They have increased the projection by 100 basis points. 1%.
Right.
So in June policy, the inflation projection for this second quarter, the July-September quarter, was at 5.2%. Now they expect it at 6.2%.
So that's above the comfort zone once again.
Above the comfort zone, yes. So that is what now we will be having the CPI numbers in a day or two, and there are expectations that the July number will be above the 6% upper threshold also.
Right.
And so we are seeing a magnified impact of the seasonal pickup in vegetable prices. So all of that would be concentrated in the second quarter. And from there on, at least the seasonal pickup in vegetable prices would start dissipating, though the other factors like cereals, spices, vegetable oils may continue. But at least this will have its major impact in the current quarter. And therefore, we are seeing that the RBI has raised its projection for the second quarter by 100 basis points.
Right.
Even for the October-December quarter, the projection has been raised by 30 basis points. But for the fourth quarter, that is Jan-March, it is kept at the same level as the last projection. So this 5.4% inflation is mainly driven by upsurge in inflation in the July-September and in the October-December quarter.
I see. And now usually in India, our inflation is driven by international oil prices
Yes.
and domestic food prices.
Yes.
Now we know what's happening with the domestic food prices,
Yeah.
but what's happening with international oil prices?
So that's a cause of concern. What we've seen in July is particularly that oil prices have again seen a rebound. And that is due to a series of production cuts that have been announced by Russia as well as Saudi Arabia, in addition to the regular production cuts by the OPEC Plus cartel. So we have this OPEC
Right.
Plus cartel
Yes.
that decides on the production target for each year. Now, in addition to that, Saudi Arabia has announced a 1 million barrel
Yes.
per day production cut. And earlier this was only till July, but now they are saying that they will extend this to August also. So every day the production is being cut by 1 million barrels. So that is for Saudi Arabia. In fact, Russia also announced another production cut. So all these on a cumulative basis will give an upside bias to the crude oil price trajectory. So which
Right.
is what we are already seeing in the, if we look at the data for the Brent crude as well as the Indian basket of crude, we are seeing that the average price of crude oil in July was higher than in June. And it's expected to even inch up in August. So that is providing a fresh upside risk to inflation. And another geopolitical factor has been the Black Sea Grain Initiative.
Yes.
So that has been, Russia has backed out of this Black Sea Grain Initiative, which is now causing increase in the vegetable oil prices. Because that was one thing, if we just look at the last time we discussed, the only component which was showing a moderation was vegetable oil prices.
But that's been reversed.
Now it's been reversed because of sunflower oil prices now starting to rise, because now the Black Sea Grain Initiative, through which Ukraine was allowed to export its supplies
Right.
through its ports, has been disrupted because Russia feel that it is not gaining anything, and it is still under sanctions. So it has backed out of that deal, which will eventually in the coming days will lead to higher prices of edible oils. And that is, we have already started seeing, but it will get more pronounced in August in the coming days. So these are the two fresh set of risks. One is global crude oil prices, and
Right.
the other is the vegetable oil prices. In addition to tomatoes,
What's already
what's
happening,
already
yes.
happening, pulses prices still remaining elevated. Even if we look into August till the first week, they are just skyrocketing. They are rising. Pulses prices, particularly tur dal, gram dal, it's all increasing. So there is now the food inflation picture is getting more broad-based. And since the June policy, at least the near-term inflation outlook has worsened. So which is what is reflected in higher projections for inflation.
Right. By broad-based, you mean that there are more food items that are seeing high inflation, right?
Yes. So earlier, as we discussed during the June policy, that at least vegetable oil prices were not seeing a rise.
Yeah.
Now vegetable oil prices are also seeing a rise. Milk prices are elevated. Spices are elevated. So mostly vegetable, fruits, all wheat and rice. And we saw government announcing offloading of some of its food stock in the open market to
Right.
cool the prices of wheat and rice. Because rice prices have risen by more than 10% in a year. Wheat prices have risen by more than 7% in a year. So now it's becoming broad-based in the sense that all the major categories of food inflation have seen an upsurge.
Right. So now we have one question from the audience, which is that, I mean, you've told us what the outlook is for, say, like August and the next month. But they're asking that till the end of the year, do we have any sort of projections on how oil prices are going to move and how that might impact India?
So see, there are two conflicting trends that are globally at play right now. One is these production cuts that have been announced by Saudi Arabia and Russia, which will pose an upside risk to oil prices.
Right.
And on the other side, we are seeing China has entered into deflation.
Yes.
So China's CPI came at minus 0.4% for July, which is a deflation, contraction in inflation.
Right.
after 2 years. So this is what we are seeing. So now China is one of the major sources of demand for global crude oil prices. So on the one side, while there are supply cuts being introduced by these OPEC plus countries, on the other side, a very major source of demand for oil coming from China will possibly get cooled. So that will impart a downward push to prices. So we need to see how these conflicting tendencies will play out in the coming months. But one thing is for sure, that oil prices are likely to remain elevated because the OPEC countries would not allow them the prices to sag. So they will introduce more production cuts if there is any, if they feel that the prices are going down due to the demand slowdown.
Right. So you've actually touched upon another issue that our audience has raised, which is that they're asking if you could comment on the deflation in China and how that might impact India. So oil prices is one.
Yes.
Are there any other?
Yes, so see, we are importing a lot of commodities from China. So if we look at the composition of our trade with China, we are exporting some amount, but we are importing a lot.
Right.
So that our imports might get cheaper, and that will have an impact on industries, companies' profitability, and so on. Another very important, at least positive impact in the near term that we can see is the impact on metal prices. Because if China's demand cools down, metal prices will see a moderation, and that is a very positive development from India's inflation perspective, our industrial raw materials perspective. So if our industrial raw materials prices moderate, then at least the cost push inflation story will not get accentuated. So that is a positive step. But in the long run, if a country, the second largest economy, faces deflation, and 2 days back we got the China's trade data also, which also showed that China's imports and exports both are contracting.
Exports by double digits.
Yes, exports by double digits. So China is having a trade surplus. So these things in the medium term do not augur well for the global economy as a whole, because it leads to a downward pressure on demand, consumer sentiments, and so on. But in the immediate term, yes, it is positive for our inflation, because we have seen some fresh sources of inflation. So at least on that front, there will be some comfort.
Right. So on a side note, if you go and read our 50-word edit on this issue, this is exactly what we've argued, that economic trouble in China is trouble for the world. And so we can't sit here being happy at their expense, because it impacts the world economy, it impacts the Indian economy. So please go ahead and read that 50-word edit. But now coming back to what the RBI has said, we've spoken about inflation and the outlook. What are they saying about growth?
So they seem to be less worried about growth, and they've pointed out at a number of high frequency indicators that we also touch upon in our article. So if we look at these high frequency indicators, we get a mixed picture in the sense that some of the activity based variables like cement production, steel consumption, all these are doing well. So that gives a confidence that the economic activity is resilient. We have seen GST collection, we have seen e-way bills collection, they are on a positive side. But there are some other variables like automobile sales, passenger car sales in particular, which have seen a moderation after rising in June. So we are not seeing a sustained increase. So there are still some discomforting trends on the consumption side, particularly from the viewpoint of passenger car sales. Tractor sales on the other side has done well this time, but we need to see whether the upward movement in the sales of tractors, does it continue in the coming months or not. So there are some early signs of pickup, but they need to be sustained. Electricity generation is doing well, but petroleum consumption has slightly moderated. So overall, though the picture is of resilience, but there are some pain points, and they need to be monitored on an active basis. But the point is, on a comparative basis, if we look at growth and inflation, based on the RBI's commentary and based on the data, RBI seems less worried about growth. And that is why it has maintained its growth projection at 6.5%. All the quarterly projections have also been maintained at the same level, no change in the growth projection. So it's only on the inflation front, they are continuously talking about maintaining a vigil on inflation and talking about the 4% target not being the 6% target, and that they want to bring it down to 4%. So that is a more hawkish, they have a more hawkish stance towards inflation, and they seem to be comfortable with the growth, though there are some upside risks that they're talking about, the geopolitical tension, the China deflation, uneven distribution of monsoon. So we need to see how they play out in the coming 2 months. So particularly the July-September quarter, the trends in these monthly variables will be very critical to analyze what happens to the growth, GDP growth for the entire financial year.
So does that mean that we can expect a pretty robust festive season as we're going into it? Where September, October is our festive season.
Yes.
Do you think that things are looking that it might be relatively robust?
Yes. I mean, on the sales front, particularly on the urban demand, things look better as compared to the rural demand. Also, if we look at credit, again, 250 basis points rate hike and still no cooling of credit we have seen.
Especially consumer loans.
Credit or household loans. They are galloping at 20% interest rate for so many months now. So that gives a confidence that consumers are buying, the sales are robust. Particularly if you look at the composition of consumer loans, it is all very robust. It's broad based and it is robust.
Right.
So that is a point to note. But on the other side, again coming to inflation, this is also a time when the demand starts to rise, and cereal prices, wheat prices are rising in anticipation of higher demand during the festive season. So all these factors need to be watched out for.
Right. So now overall we have figured that inflation right now is being driven by food prices and international oil prices.
Correct.
These are not things that an interest rate hike could have addressed.
Yes.
So do you think that the RBI was correct in keeping its rates unchanged?
Yes, RBI was correct, and it has already hiked by 250 basis points. And what we normally see is that there is a lag in the transmission. So RBI raises rates, it has its impact in the subsequent quarter.
Right.
It takes almost a year to see the trickle-down impact of interest rate on demand or on cooling of prices.
Right.
So that is why the narrative is that RBI wants to analyze the impact of the 250 basis points rate hike on its the various macro variables. On the other side, as the narrative says, they want to maintain the vigil on inflation, because even though you are right that interest rates do not have an impact on food inflation, but interest rates do have an impact on inflation expectations.
Yes.
And when we are talking about food prices, inflation expectations tend to get influenced by food prices disproportionately. So if food prices are rising, inflation expectations tend to become unanchored, and therefore it is important to keep a vigil on inflation and also to shape the interest rate decision based on what happens to food prices and its transmission to the other components.
Right. So now this inflation expectations concept is actually very interesting, because in the past, I at least have noticed when I was covering all of this actively, that the RBI sometimes would do a surprise move because it wanted to run counter to expectations. But here they're keeping with expectations. We expected them to keep rates unchanged and they've stuck to it.
Yes. So that expectation is actually the market expectation. But when they make their decision, they also look at what's happening to consumers' inflation expectation, particularly household inflation expectation. And household inflation expectation are driven by food prices, even though food does not constitute the whole of inflation, but it is driven by food prices. So it's very important to keep a vigil on food inflation and overall inflation to anchor expectations.
In your article, you talk about one surprise move by the RBI, which is to do with liquidity.
Yes.
So could you tell us a little more about that?
Yeah, sure. So first, for some basic concepts. So RBI, in addition to management management of inflation through interest rates. RBI also manages liquidity into the banking system.
Right.
Because if liquidity is in excess of what RBI feels is a normal level of liquidity, it will start having an impact on inflation. It
Right.
will lead to higher inflation.
Yeah.
So RBI manages liquidity in the banking system through what is called the variable repo auction and variable reverse repo auction.
Right.
So in essence, when banks are facing shortage of funds, they can borrow money from the RBI through repo auctions. And when banks have surplus funds, they can park their funds with the Reserve Bank of India, and RBI then pays them some interest rate.
Right.
So that is called variable reverse repo auction. So in the event when the liquidity is surplus, RBI announces more of reverse repo auctions to give an opportunity to banks to park their surplus funds with RBI.
Right.
That will help in absorption of surplus liquidity from the RBI. So RBI has been doing this over the last couple of days. But what we are seeing through the data is that banks are not being forthcoming in parking their funds with the RBI.
I see.
So this variable reverse repo auction is not being successful in absorbing the amount of liquidity that RBI wants these auctions to absorb.
And the RBI is not happy about
RBI
this.
is not happy. And why? So banks are being cautious. They want to keep some amount of funds with themselves. So they are not parking their funds with the RBI. Sometimes there is 60% subscription, sometimes there is 70% subscription, but not 100%.
Right.
So liquidity is not getting, moderating to the extent that the RBI wants it to. And it has risen in response to the 2,000 rupee notes that have gone back into the banking system. So to counter this, because liquidity can have an impact on inflation, RBI is already worried about inflation. Therefore, RBI has now introduced this tool which is called incremental cash reserve ratio. And they had announced a similar instrument during demonetization also, because
Right.
at that time also there was an excess liquidity because old notes went back into the banking system. So there's already a cash reserve ratio, which is 4.5%,
Right.
which means that banks have to park 4.5% of their deposits with the RBI on a fortnightly average basis.
Right.
That is already there. So now they have introduced incremental cash reserve ratio of 10%, which is on the increase in deposits that have happened between May 19 and 28 July.
Basically, the 2,000 rupee note.
2,000. So in
I
order
see.
to counter the excess liquidity due to the coming back of 2,000 rupee notes, they have introduced this incremental cash reserve ratio instrument. And it is a temporary measure, but it
Right.
came as a surprise for the banks also, because and RBI did this because banks were not cooperating and they were
Right.
not parking funds, even though RBI was offering them interest rates. So now they have to park funds free. So that will
Yes.
lead to a cost for banks. So that is a surprise move.
But this might also be a lesson for banks that if the RBI is allowing you to park funds with them and give you an interest rate, then take that option
Yeah.
instead of having to do it for free.
Yeah. So see, the banks have other alternatives. Some banks. So there is what we now see as a disproportionate liquidity distribution. Some banks are having surplus liquidity. Some banks are having deficit liquidity.
Oh, I see.
So that is also a problem. And some banks are they are cautious. So they want to keep money with themselves. But RBI is not happy with that, and therefore this ICRR has been introduced. This will be reviewed on 8th of September. It might get withdrawn if the liquidity gets absorbed,
Right.
but it needs to be seen how it plays out. So this was not expected, but this has been done so that excess liquidity does not spiral inflation further.
Right.
So this is a move to control inflation without hiking interest rates.
So there you go. The RBI has not changed the interest rate. It hasn't increased it. It's definitely not reduced it. It's kept its stance the same, which is a withdrawal of accommodation. Its outlook on inflation, though, it's saying that inflation is set to rise more than it had earlier expected in its the monetary policy decision of 2 months ago. It's saying that inflation is set to increase over the next half of this year. On growth, it's much more calm about growth. It's more concentrating about inflation because, as the RBI governor said, the target is 4%. And so even if inflation is below 6%, that doesn't mean that we can relax. They want it to come down to 4%. but there are various things that are happening in the world. Oil prices are rising. The various oil producing nations are implementing production cuts. So that will drive oil prices up. But at the same time, the Chinese economy is not growing as fast as it should. And it's entering a deflation period. So maybe that will bring oil prices down. So we don't actually know fully clearly what the medium term outlook on oil prices will be. So the RBI is just saying that we are going to keep an eye on inflation. Growth will take care of itself. On liquidity, they've also taken some interesting moves. This is basically to ensure that all of the liquidity that is there in banks doesn't start pushing inflation up. So all in all, it's a wait and watch kind of mode that the RBI is in, and we'll know what additional measures they'll take 2 months from now in the next monetary policy meeting. But on that note, that's all from us. Thank you so much for watching. But before you go, I have an appeal to make before you, which is please subscribe to ThePrint. It allows us to do the ground reporting that we are so good at. We bring you stories from around India that nobody else does. It allows us to do discussions like this. But apart from that, it gets you a lot of other benefits, such as our exclusive webinars that we do with various experts. It allows you to write into us in our Your Turn section. Your opinion is published by us as an article. And of course, it gets you our exclusive newsletters to your inboxes written by our editors. So please do subscribe. The link is in the description of this video. And thank you for watching.